Hey, Adam Hooksema here from ProjectionHub, and this is the second course in a 6-part series on how to buy a small business with an SBA loan. And in this second course, we are going to be really diving deep into SBA loans. And I really want to do this early before we dive into, how do you even find the right business and how do you do the due diligence on that business? Because I think what often happens is people get to the SBA part too late in the process after they've found a business that they want to buy. And then later they find out, oh, this doesn't qualify, or this is just not going to be a good fit for SBA. So let's focus on what it's going to take to be a good deal for SBA on the front end, and then make your search kind of built around that or built with SBA in mind right from the get-go. So that's the idea here. Today, we are going to be focused on everything SBA. And if you haven't already watched the first introduction video, I would recommend go in the description of the video below. We'll have a link to all of the courses, each course in the 6-part series. But I think it would make sense if you're new to this, go back to the first video, watch that first, get that kind of baseline, and dive into the details of SBA here. All right, so the objective for today, we want to make sure that by the end of the session, you'll know, should your deal be an SBA 7A loan deal or a 504 loan? So those are two different core programs of the SBA. What are realistic terms? What should you expect in terms of the terms of the loan? How much equity do you actually need to put into the deal? What do some lenders love? Why do some lenders love acquisition deals and others not so much? And then what are things that are going to kill your deal before you even apply? All right, so first off, just who's in the deal? Who are the three parties here? So you've got yourself as the borrower. You're going to be personally guaranteeing the loan. Any owner who owns 20% or more of the business will need to personally guarantee the loan. You must meet SBA eligibility requirements, and you're personally responsible for the repayment. Even if the business fails, you personally are still on the hook. And every owner who owns 20% or more of the business is 100% on the hook for the entire SBA loan with that personal guarantee. The second party involved is the lender, typically a bank or maybe a credit union. They are providing the funding. They're underwriting the deal. SBA is not the direct lender. So the third party here is the SBA. They don't lend you money directly. They are providing a guarantee to reduce the lender risk. So it's almost kind of like insurance. The SBA will set the rules and the guidelines. And then, if the loan goes bad or defaults, the SBA will come in and cover a portion of the loan. So here's how that kind of works, and why it matters to you is that with the SBA in place, you're going to be able to get approved for loans that a bank would not approve if the SBA wasn't involved. Okay, so you're going to be able to get longer terms. So typically the term on an SBA loan for an acquisition is a 10-year term versus maybe 3 to 5 years on a traditional or conventional loan. You can have lower down payments, like 10% down payment on an SBA deal versus probably 20 to 30% on a conventional loan. You're going to get better rates. If you go to a bank and get a true conventional loan from a bank, that's probably your lowest interest rate. That means you're really strong. You're putting that big down payment, but SBA is likely to be a better interest rate than, your online lenders, your alternative lenders, your credit card companies, factoring, merchant cash advances for sure. So you're going to have more likelihood of deals getting approved with the SBA in there. And that SBA guarantee is 75 to 85% of the loan. So if you default, the SBA pays the bank back partially. This makes lenders a little more willing to take on some risk. And if you didn't have the SBA involved, the bank has got to be 100% confident. I mean, they want like no risk at all that you're going to default, meaning they're probably going to need to be fully collateralized. I think that's probably one of the biggest things with SBA is they help in situations of collateral shortfall. So when there's not enough collateral to fully secure the loan, that's where the SBA can be a really helpful tool. So there are two key programs. When you hear SBA, probably thinking of the 7A loan. That's kind of the flagship product, but there's also a program called the 504. I'm going to talk through both of those and kind of key differences here. So the 7A program is great for buying a business. It's most common for acquisitions. You can use it for working capital. You can use it for equipment. You can use it for real estate. And then the key features, the SBA guarantee is 75% on loans over $150,000 and actually 85% on loans under $150,000 with a maximum loan of $5 million. You can have up to 10-year terms for business acquisition or equipment. And then if the loan is going to be used for real estate, you can actually have a 25-year term. Now, there's a little bit of nuance here, and different banks will do this differently. And I mentioned this in the first course, but if the acquisition loan, if greater than 50% of the loan proceeds are going to purchase real estate, then the entire loan can be put on a 25-year term. So if you're acquiring a business for $1 million and that includes the business operation and the building or the property, then if that property is greater than $500,000, greater than 50% of the total, you can put the whole thing on a 25-year term. If the real estate's 40% or 30% of the deal, then you may have a kind of a blended term. So it may be, 15 years based on that blended rate. Lenders like the SBA 7A program because they can sell the guaranteed portion on a secondary market. So the way that works is SBA lender makes the loan to you, then they take the 75% guaranteed portion, they sell that to investors. There's a market for this, and they'll immediately earn, call it 8 to 12% premium typically. And this changes all the time based on market conditions, but let's just say it's 10%. They're going to earn that premium immediately. And so banks really like the 7A product for that reason, or at least the lenders that really like the program are often using it. They're often selling the loans. Now, some lenders will actually keep their loans on their balance sheet. They won't sell the guaranteed portion, but most of probably the most popular SBA lenders or the highest volume SBA lenders are probably selling their loans. And the 7A program is a lot faster to process than the 504 program. So the 504 program is mostly used for real estate, large equipment purchases, long-term fixed assets. It will have a lower interest rate. Almost certainly it will have a lower interest rate than the 7A program. So that's why a lot of times people are interested in, could I use the 504 program? So the way that it works, the typical structure is there is a 50% bank loan. So 50% of the deal is a conventional bank loan and it's in first position. So if you think about it, if you're buying a $1 million business and let's say $800,000 of it is real estate, the bank can come in and provide $500,000 of that deal and be in first position on $800,000 of real estate. So the bank feels pretty safe. So they like it from that perspective, which means they'll probably give you a decent rate. The bank's going to give you a decent rate. And then the 40% that is from the CDC lender is SBA guaranteed, and it is going to be in second position. It's also going to be at a low interest rate, probably lower than the bank loan portion. And then so you have kind of a blended rate. And then you're going to put in, as a buyer, you're going to put in probably at least 10% equity into the deal. So it does have some benefits. There's the longer terms, lower payments. There are some complexity, some requirements, job creation requirements. And really, it just comes down to it's more complex and it's going to be slower because there are two lenders involved. There's the bank and there's the CDC lender. They each have their own underwriting department, their own staff. Sometimes the CDCs and the banks work really well together and sometimes they don't. And so an acquisition deal is already really complicated because you've got a buyer and a seller. You've got multiple parties involved. When you layer in also a bank and a CDC lender, it just increases the complexity even more. So for a lot of reasons, lenders don't typically love to do the 504 program if they can avoid it. Some advantages here for 7A, it's one single lender, simpler, faster. They can sell it immediately, make that premium. The premium kind of creates this bonus pool. So what often happens is the loan officers, your lender, is probably making some sort of commission on the deal. Well, when the bank sells that loan, if they earn a 10% premium, they can take 1% and give it to the loan officer, right? If they're not selling their loan, like with the 504 program, it doesn't create that same incentive structure. So you're going to have loan officers and loan brokers and partners are all probably going to be thinking, hey, 7A is the way to go because of that incentive structure. The 504 disadvantages, there's the two lenders that must coordinate. There's no immediate kind of premium earned. The bank will often try to build in a fee that they will charge you and then pay the loan officer, the loan broker bonuses out of that fee. And there's just, more paperwork and time. So I think the reality many times probably makes sense to just try to get your deal closed with a 7A. You're kind of swimming against the stream with the 504, in my opinion. Get the deal closed with the 7A program. With the 7A program, there is no prepayment penalty if you're on a 10-year loan term. So you can pay off that 7A loan at any time. If you're on a 25-year term, there is a prepayment penalty in the first, second, and third year, and it kind of decreases each year. But after 3 years, you can pay off the 7A loan and refinance that without any prepayment penalty. So what I often see folks do is they say, let's just get the deal done with the 7A loan, close the deal, and then in a year or 2 or 3, we can decide if we want to refinance. If there's that much interest rate savings later, we'll worry about that later. And so in that case, if you're, on a 25-year term or even a 10-year term, you may only be paying that higher interest rate for a couple of years. So that is something to consider. Sometimes 504 might actually make sense. If you are buying real estate, if you're okay with waiting, you want to wait for a longer closing time. If the savings is really important to you, and then if you can qualify based on the job creation and retention benchmarks, and if your deal fits that structure with that 50-40-10 model, then it can make sense. But again, typically we'd probably say there's enough complexity already in your deal. You don't need this extra layer of complexity. Just get the deal done and worry about refinancing if it really means that much to you later. So the typical terms for an SBA loan for an acquisition: minimum down payment of 10% of the total project cost. And for, a strong deal, you're kind of in that 10%, maybe 15%. If the deal is weak or under collateralized, some lenders, and it just depends on the lender, but sometimes they may want more equity in a deal. And then the equity can include a seller note on full standby. And so I mentioned this in our last video, but what does this mean? So if you need to come up with 10% equity on a deal, let's say we've got a $1 million acquisition, you need 10% equity, so you need $100,000. Well, let's say you've only got 50 able to commit to this. If the seller is willing to do a seller note, where they're effectively lending you the other 50,000 for the down payment, or you don't really need to think of it, they're not giving you the 50,000. They're just accepting a reduced dollar amount at closing. So they're accepting, 950,000, and then they're going to get paid that final 50,000 later on the seller note. So if they're willing to do a seller note on full standby, meaning you can't make any payments on the seller note until you've paid the SBA loan off, then the SBA will allow you to consider that 5% seller note as equity in the deal. So it's a way for you to be able to, buy a larger business than you would otherwise. If you only had $50,000 of cash available to put in as a down payment, and you need 10% equity, you can only buy a $500,000 business. If you have a seller note on full standby, you could go up to $1 million business in this example. Interest rates for SBA range from lender to lender and deal to deal, but just consider it prime plus 2.75%. So the prime interest rate plus 2.75, and typically going to be a variable rate. You can do a 10-year term up to 25 years. Typically the acquisition deal is going to be 10 years. And most likely your repayment is going to start right away. A month after closing, you'll have your first loan payment due. Probably not interest-only period, because the business is already operating. Interest-only periods tend to be used in startups and where there's a ramp-up period or a construction period to build up. But that's the upside of an acquisition deal that's already operating and profitable and cash flowing. You really shouldn't need an interest-only period. So you'll start with principal and interest every single month. So here's some different ways to kind of structure deals. We kind of hit on this already, but you could put in that 10 to 20% in cash. If you're a buyer and you've got that cash available, you have it in your bank account, and you can prove that to a lender. That's what a lender loves. If the lender says, "Hey, do you have the down payment?" and you say, "I can come up with it. I'll figure it out." Usually that's a red flag for lenders. Like, nope, not going to work with you until you prove that you've got the down payment, because usually what it means when I'll come up with it means like you're borrowing it from somewhere, and lenders don't want you to be borrowing your down payment. The point is it should be equity. It should be cash that you have from savings or from equity investors, not loans. So option 2 is you can have that 5% cash from the buyer, 5% seller note on full standby. And then the third option is that buyer cash plus an equity partner. So you could bring in an investor, and as long as they have less than 20% ownership, they won't be required to personally guarantee the loan. So typically investors are not going to want to personally guarantee the loan. So you would want to keep them under 20% equity. And there are some requirements there with SBA on that ownership. So those are kind of 3 of the most common structures. There are some SBA eligibility and deal structure rules that I want to hit on. So if you are, buying a business, you must be acquiring 100% of the business, or the seller has to guarantee the whole loan. So if this is a relatively new change, the way it works now, if you were to buy 90% of the business and the seller was going to retain 10% of the equity, the seller actually has to personally guarantee the entire SBA loan, which what seller would want to do that? I mean, there are very few situations I can think of where that would make any sense. So really, the SBA clearly did not want to support partial buyouts of owners. They wanted to be supporting, 100% acquisitions. So that's pretty much what everyone's doing these days. So the seller must typically exit the business completely. Now, there's some nuance there where the seller may be able to guarantee the loan for a couple of years and then the guarantee can go away. But still, I don't know many sellers who are going to say, yes, I'll sell you 90% of my business, but I'm going to guarantee the loan. Like, why would they do that? There are some working capital expectations. So lenders want 1 to 3 months of operating expenses in reserve. They want that to be included in the total project cost. And there are ineligible businesses as well. So if it's a passive real estate holding company, so like you want to buy a rental property, can't do that. Lending or investment businesses, nonprofits are not eligible. Businesses not based in the US, speculative businesses, all are ineligible. And then everyone's going to have to personally guarantee anyone who owns 20% or more of the business. And this does include your spouse and community property estates. So yeah, you need to your spouse probably needs to be on board regardless. Like I would, don't buy a business if your spouse isn't on board with the risk. I mean, you're personally guaranteeing it. You're potentially putting up the equity in your home. Just make sure you're together and on board is my recommendation. Okay. So to talk about kind of the SBA lender landscape. The reality is that not every lender is the same, and finding the right lender matters a lot. And we've put together, and we're going to show you this in course 5. We'll show you our SBA lender finder tool. There's a little screenshot of it that kind of shows how you can sort and filter all the different SBA lenders and see, who's made the most loans in your area, in your type of industry and business. But there are some banks that will do hundreds of acquisition loans a year, and then there's some banks that will do hardly any. So it's important to find a lender that is familiar, not just with SBA, but SBA acquisition loans, and that they do them in your state is really helpful. But even finding just the right lender, the right bank, it still matters the individual person. Like the person at the bank can really, make or break your deal as well. So really find not only the bank, but a individual person that you can communicate well with, that you like working with, that has experience closing deals like yours. Live Oak Bank is kind of the national leader in acquisition deals, or well known as the acquisition kind of king. Huntington Bank does a ton of SBA loans just in general. They typically do some of the highest volume. And then if you've got a deal that is tough to get approved, local community banks, credit unions, those might be best for smaller deals, particularly, anything under $500,000. It's hard to get the national SBA lenders too excited about doing them. Some will, but you're not going to be their top priority. So if you've got a acquisition for $300,000, which may be very meaningful to you, but very non-meaningful to a large national SBA lender, I would consider going to a local community bank. Some red flags, if somebody says, oh yeah, we do SBA, but I look up their data. You can look up their data with our tool and see how much volume do they actually do. And if they've done less than 10 acquisition deals in the past 5 years, and yikes, I'd be pretty nervous to work with them. If they don't have a dedicated SBA department, it just means there's going to be more delays probably because they're using some lender service provider who's part of the process and potentially making decisions. And so it's just you're complicating things more. There's more people in the way of you and approval. Here's some things that kill SBA deals. Credit scores less than 650. If you've had a recent bankruptcy, really any bankruptcy, it's possible that if you've had a bankruptcy that's been long enough ago, that'll be okay, especially if it has a good story, a good reason to go along with it. If you have any current tax liens or unpaid taxes, it's just you're not ready for an SBA loan. Another issue is cash flow. So if the business isn't profitable, if the business can't cash flow the debt historically, then you're not going to find an SBA lender to do the deal. The lender has to demonstrate to the SBA that you'll be able to cash flow the loan. And the way they demonstrate that is with the debt service coverage ratio. And so that just means if it's 1.25, that means you have $1.25 of earnings or cash flow available for every dollar of loan payments. And typically lenders want you to have a debt service coverage ratio of 1.25 for at least the last couple of years. Some will want all 3 years on the last 3 years of tax returns and year-to-date on the year-to-date financials. They'll also be looking closely at like declining revenue trends. So if it was like, hey, 3 years ago, we had a 3.0 debt service coverage ratio, and then it was 2, and then it was 1.5. Well, yeah, technically you're ahead of that 1.25, but the trend is concerning. That's going to be, an issue as well. Technically, an SBA lender can make a loan for an acquisition for a deal that has not historically cash flowed. So they could do a projection-based loan, and they could say, hey, this hasn't cash flowed historically, but we have a strong buyer who has great experience, and we think we can make the case for they're going to make these changes, and that's how it's going to impact cash flow. And going forward, we're projecting they're going to hit this, 1.25 debt service coverage ratio. Now, with that debt service coverage ratio, every lender is different. Some lenders want you to have 1.6 for each of the last 3 years. Some want 1.6 in just the last year. Some are okay with 1.15. You can get as low as 1.15 according to SBA. Some are willing to do it just based on projections. So there are lots of nuances there from lender to lender. This is something, if you want to reach out to me, feel free to reach out to me over email, adam@ProjectionHub.com. We'll put contact information in the description of the video below as well. If you want to run a deal by me and say, who do you think, what kind of lender would like this deal? How could we get this done? I have a fairly good sense of what lenders like what. So I'm happy to help with that. From an eligibility standpoint, the seller staying on as a partial owner, we already talked about, could be an issue because they'd have to personally guarantee. Got eligible types of businesses. We talked about collateral shortfall. So if cash flow isn't very strong and you don't have any collateral, or it's not very much collateral, then that can be a deal killer. And if you're unwilling to pledge available collateral, that can be a deal killer because the lender doesn't really have a choice. If the deal is under collateralized and you have additional collateral or equity in your home, the lender is going to be required to take it. It's a way to protect the taxpayer. It's just a requirement. So keep that in mind. And then a poor structure to the deal. And so this could be a purchase price that's just way above the market valuation. That'll kill the deal. Every SBA acquisition loan is going to be required to have an independent third-party valuation done. And if the valuation comes back at, $800,000 and you had a purchase price of $1 million, you're going to have to either renegotiate the purchase price down, or you're going to have to come up with more equity. Basically, your loan is going to go down to the value of whatever that valuation is. So if you still want to buy the business, you might have to put in more equity yourself. You might have to get investors to put in more equity. You might have a seller note on full standby for the difference. There are still some options, but the SBA loan is now going to be limited based on the valuation. Also, if the seller has a whole bunch of add backs, but they don't have any documentation, they say, oh yeah, we spent a bunch of money on a one-time, we had a freak accident. Just had a conversation with somebody, said there was a high-speed chase outside of this business, and a car actually ran into their building in the police chase. And, it cost them a big chunk of money for repair. So maybe they spent, $40,000 or something out of pocket as for repairs. Okay, that is probably a one-time thing and should be an add back. So that would be a good example of an add back, but there are many examples where people say, oh, this was a one-time thing, when really it's recurring. This is a thing that happens all the time. Maybe you had to replace a furnace. Well, yeah, you're going to have to replace furnaces. You're going to have to replace roofs. You're going to have to replace your equipment from time to time. So those are less likely to be add backs that a bank is willing to accept. And then if there's just too much goodwill versus the hard assets, and really that just gets back to valuation as well. Okay, that is really the run through of the SBA. So some action items before our next course 3, some things you can do. Calculate how much you can put down, and then you can back into what your total deal size. So if you said, oh, I've got 100,000 available, your deal range is probably in the 500,000 to $1 million. You can kind of set some guardrails. Okay, what's my minimum and maximum purchase price and minimum seller's discretionary earnings? Now, part of this is going to come down to whether you need a salary. And so this is something that you'll really need to keep in mind. And we'll get into this later. But if the SBA lender says, hey, you're leaving your job, and we look at your personal financial situation and say, hey, you need $75,000 a year to live on, the lender is going to require that you pay yourself $75,000 out of the business proceeds. And that's going to impact your debt service coverage ratio, because the seller is going to say, oh, we had $275,000 of profit, so we've got $275,000 available for debt service. But if the bank says, nope, you, Mr. Buyer, Mrs. Buyer, need to take $75,000 as your own salary, now you only have $200,000 available for debt service. And that's going to impact that debt service coverage ratio and ultimately impact the price that you can pay. So it's an important thing for you to consider. And then check your SBA eligibility. So that credit score, bankruptcy, make sure you have paid all your taxes. If you have prior convictions, you'll want to check whether you're going to be eligible or not based on your particular conviction. And you need to have your available collateral well documented, your down payment documented. So, at some point, lender's going to say, or even a business broker or the seller may say, hey, show us that you have the down payment, show us proof of funds. And so, if you're going to rely on your down payment coming from a gift from a friends or family, like you may need that in hand, now while you start your search. So that's just something to be aware of. All right, next steps. Our next course is finding the right business. So now that we've kind of talked through SBA and have an understanding of what SBA is going to require, that will help us weed out businesses that aren't going to be a good fit for us. So now we'll talk about where to actually find businesses for sale, the different online marketplaces, working with business brokers, and then off-market search strategies as well. So businesses that maybe are not actually listed for sale yet, but they may still be good opportunities. And then you can see course 4, 5, and 6 that will be coming up after that. Again, we will put a link in the description of the video below to prior course as well as the future courses as those are released. And also share my contact information again with you here. So feel free to reach out to me. If you have a deal that you're looking at or just want to have a conversation, feel free to reach out. Adam@ProjectionHub.com is my email, and we'd love to help. We do have a free SBA review that I'm happy to do. So if you've got a deal that you're looking at, we'll put a link in the description of the video below. You can fill out this free SBA review form, and I'll give you some free feedback on your situation, the deal, and how I might approach it and whether I think it sounds like it's something that could get done. So if you found this video to be helpful, I'd really appreciate it if you would like the video and subscribe to the channel so we can help others find this content as well. And we appreciate you, and we'll see you on the next one. Thanks.